the Portgordon man behind the voice known to 300 million, to grasp how bearish October was for the stock market, consider just a few of the headlines posted last week. From Barron's, what to expect from the stock market after a brutal October. From MarketWatch.com, the godfather of chart analysis says damage done to the stock market is much, much worse than anyone is talking about. From CNBC News, the Nasdaq dropped 9.2% in October, its worst month since November 2008. The boys and girls on Wall Street whimpered all week, "Woe is us." However, commodities, per se, did far worse than stocks for September as well as October. For instance, in September, gold prices hit a 1.5-year low while coffee and soybeans dropped to a 10-year low. Sugar hit a 6-year low, cotton prices slumped to an 8-month low, and orange juice a 1-year low. That was in September, and then along came October with wheat prices falling to a 9-month low, crude oil slipped to a 5-month low, and the CRB index, that is to the commodity markets as the Dow Jones is to the stock markets, fell to a new 2-month low. September and October were stone cold bearish and commodities did far worse than stocks. But October is gone, and with 2 months left in this year, the battle lines are drawn between the bulls and the bears about the direction stocks and commodities are headed from now into January. And, as always, only time will tell. My lean is the stock market will go nowhere for the next 10 years. But Goldman Sachs is convinced the Dow will rise sharply into the end of this year, while Morgan Stanley believes it is headed lower to much lower as a new bear market is unfolding. Here too, only time will tell. The big news last week, and it began on November 1, was the sharp decline seen in value of the U.S. dollar. Earlier in the week the all-greenback hit a new 16-month high, falling short of the 97 level, but closed sharply lower. The decline that day was the largest setback in a year. Why is that the big news this week? It is the big news because history shows a near-perfect inverse relationship between the dollar and commodities. When one goes up, the other goes down. Thus, the sharp break in the value of the all-greenback hints loudly that sooner than later, commodity values in general will improve from current levels. In fact, when the dollar did a nosedive, gold prices rose nearly $20 an ounce and silver prices jumped a whopping 48 cents an ounce. It was the largest one-day rally for both metal markets in a year. History shows the first commodity markets to benefit from a bout of inflation are precious metals. If the dollar has topped out and headed lower and commodities, per se, are about to catch a tailwind, the market I would concentrate on in the weeks ahead is Kansas City wheat. Wheat prices tend to be very sensitive to the dollar, and global supplies are the smallest since 2007 when K.C.